Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update and the first update of 2023. Today is Thursday, January 5th, and it's about 1:30 on the West Coast. And like I talked about last week, I'd like to get into looking ahead to 2023, but just to get you guys caught up on the last week. Average conventional rate last week was 6.5. Today it's at 6.5. We've heard a lot in the news or a lot of noise coming out of the Fed. They're definitely making it clear that they like to see job loss before they pivot and either stop hiking rates or even cut rates. At the same time, we're getting positive job numbers. Job creation's higher than expected, unemployment lower than expected. So you couple those two things, you couple the Fed wanting to see job loss and no job loss happening, the markets are trying to shake that off. We'd like to see, not that you want to root for job loss, but we definitely like to see the Fed to pivot. So definitely, when you see in the news any job reports, keep that in mind. So the worse job numbers come across, the more likely the Fed will pivot. So let's jump into 2023, and let me hide myself here so you guys can see a little better. So I've shared this with you guys before just to show why we're at where we're at. Inflation drives mortgage rates. So as you can see, they generally mimic each other. They're in about March of 2021. Inflation started to jump up quick. Rates hung on for a little bit because the Fed was propping the market up a little bit. But once the Fed stopped doing that, you really saw mortgage rates, spike like we have over the last year. But you've also seen mortgage rates start to come down as we get positive inflation numbers, as those come down as well. So just keep in mind, inflation tends to follow, or mortgage rates tend to follow inflation. When will inflation peak? So this is an important question, obviously. When will we see inflation come down to where we need to come down to? So the way it works is each month we're replacing last year's month. And so here in January, we'll get December 22 numbers. And, as you can see, most of these numbers are pretty elevated. March and July are a little lower, but mainly pretty elevated numbers. And that's one reason we feel pretty confident, that as inflation comes down each month, it'll be replacing one of these numbers, and we'll see that overall number come down even more. And like we just talked about, inflation comes down, so do mortgage rates. So a big part of inflation is what they call shelter costs, and it makes up 39% of the core reading, which the Fed really likes, which is just takes out food and energy. So this pink line is apartment list, their rent year-over-year change. As you can see, it stayed pretty consistent, dropped in 2020, and then really spiked beginning of 2021. And since then, though, it's fallen off a cliff, really. It's come down pretty quickly, down to 4.6%. So now I'm going to add in, this is the CPI. This is how the inflation data that the Fed goes off of is looking at rent right now. And as you can see, that's still climbing. So there's definitely a disconnect at 7.9% compared to 4.6. Definitely a disconnect between the two. So we know it's coming down. We just need it to hit that inflation data. So starting in January, we should be on the other side of that hump. And that is one reason why we're pretty confident that those inflation numbers going forward will be even better than we could hope for. And then so really, like I said, basically everything, food, gas, clothing, everything's coming down except for that shelter cost. So once that shelter cost comes down, we should see, very nice gains in those inflation numbers. So another reason, one thing to look at is, here in the mortgage industry, we're pretty confident we're either already in a recession or recession's on its way. Depends on who you talk to. But these two graphs, there's lots of different things you can look at to predict, when we have recessions, and all are pointing that direction. But I felt like these were two good ones to share with you guys. Credit card and other revolving debt at the top. As you can see, credit card debt was on its way up. We got stimulus money went down, and then stimulus money ran out, and all of a sudden credit card usage is skyrocketed. And then down at the bottom, personal savings rate. So basically people's bank account numbers was, kind of low, spiked during the pandemic when we got stimulus money. And then since then, besides a couple little blips, it's come steadily down. So people's credit card debt is going way up and people's savings are coming way down. That obviously is not good for the average American and is recessionary. And one reason why we shouldn't be as concerned, at least in the mortgage industry, about a recession happening is historically every time there is a recession, mortgage rates come down, either during the recession or towards the tail end of the recession. So, besides inflation coming down, if we do head into the recession that everybody's kind of expecting, at least on the mortgage rate side of things, we should see our rates come down with it. One more reason why we feel pretty confident going into 2023 in the mortgage industry is, going back in time, we used to give a lot of money to people that weren't very well qualified with under 620, under 659 credit scores. once the government got involved and kind of slapped us on the wrist and regulated things a little bit more, you really see the originations or loans given to lower credit scores drop off a cliff, and you see people with better scores really taking up the lion's share of all the loans. So the reason that's important, and as we head into 2023 and possible recession and things like that, a vast majority of people that are homeowners currently are very well qualified, and there's less chance for them to default on their loan. The numbers indicate that right now, where late payments and foreclosures are all at decade low numbers. So right now, the loan industry, loans are very healthy. People are not defaulting on loans, not paying, and so that's one reason. Another reason why we feel confident going into 2023. And then looking at home prices, just to give you guys an overall look, because we get a lot of the news about hearing prices decelerating, coming down, is going back to 2020. If you bought a house nationwide, 10 years ago, you're up 115%. 2 years ago, you're still up 39%. Really, since about June, July of 2022, we're down about 2.5%. So really, there's only a small portion of the people that bought over the last 10 plus years that should be concerned. Everybody else that bought before then, you're doing really well. And even if it does come down a little bit here, we expect it to, once we get through this rough patch, to go up. So being a homeowner would still be a good investment. And so, let me go to their little thing here. So how this is basically their little summary, for reasons we, covered before, they expect low single digit appreciation for most of the U.S. with a pickup in activity. And I would agree with that. If we stay in the low, 3-4%, which is still a good investment, appreciation. And maybe in some markets we see that drop a little bit. Some markets we see that a little bit higher. And then pickup in activity, I definitely agree with, as we see rates drop. All of a sudden, some of these buyers on the sideline that wanted to sell their house and buy a new one are going to be more interested in getting that not a 3% rate, but maybe a 5.5% rate or so. And so their mortgage rate forecast, the headwinds, the reason things we have to deal with. There's a lot of global stuff going on. Here domestically, we have debt to be financed. We just passed that spending bill. That's a hurdle to get over because that has to be paid for, and that's inflationary. But some of the tailwinds, like we talked about, we have lower inflation, we have excess retail inventory. There's going to be more value for the people, these investors that service these loans, which will pass on some savings to borrowers. And then, like we talked about, there's a recession likely, and rates come down during recession. So, we're pretty confident that mortgage rates are going to come down. MBS Highway's thinking about 5%, their 10-year about 3% or lower. That would be awesome if we can get down to near 5%. Even mid-5s, I think, would be really, really helpful for the markets. And let me get out of here so you guys can see me again. So one thing to keep in mind, though, so, really we think mortgage rates will come down in 2023, going in, past the first quarter, going into the spring, and that will lead to more activity. So, one thing to keep in mind, if you're a buyer, you're a buyer's agent, and talking to buyers, a lot of people want to wait till those rates come down to go and buy. But what will happen when rates come down is we're in a really low inventory environment right now. So if all of a sudden we have no houses available to buy and everybody wants to buy because rates are lower again, then that's going to create kind of a mad rush like we had over the last couple of years, where you're going to have, instead of a couple offers, you're going to have 10 offers. You're going to have things going over asking. Seller credits, which are pretty popular right now, will probably go away because it'll be more of a seller's environment. So that's something to keep in mind. Even if rates being lower sounds great, but it's also going to probably bring up the prices on homes for sale. It's going to be harder to buy the home you want. Whereas right now, if you're looking to buy, you're not dealing with a lot of competition, a lot of people on the sidelines. You're able to negotiate with the sellers. You're able to get seller credits, lower prices, and all that. So that's just something to keep in mind if you're a borrower or an agent, is that lower rates sound great for everybody, but what will that do to the markets when that happens, when rates come down again and there's no, it's a really tight inventory environment right now? What will happen? It will create that feeding frenzy. So that's just something to keep in mind. But either way, rates coming down will be a good thing. And, hopefully that would create, with a hotter market, hopefully that would create some more inventory, because then we have, builders more likely to build again, and we have sellers more likely to sell again when they get what they want for their house. So that's all I had for you guys this week. 2023 should be an interesting year. Like I said, we were pretty optimistic that things will come down, but hopefully, we don't have too much of a recession in the country and not too much job loss. So if anybody needs anything at all, or wants any clarification on any slides, or, has any questions, about anything, feel free to reach out, and I'd be more than happy to help. Have a great week, everybody.